Welcome to the world of the stock market, where fortunes shift as quickly as the weather. Today, January 13, 2026, we're diving into a trend that's capturing investors' attention: the market's mood. Think of it like reading the crowd at a sports game. Are they confident or nervous? Right now, the S&P 500 is seeing a surge of confidence, and we're here to unpack what that means for you. Market sentiment, how investors feel, can drive prices up or down. When optimism prevails, buying increases and prices rise. When pessimism takes over, selling pushes prices down. Analysts at firms like Citigroup use sophisticated tools to measure this sentiment and guide investment decisions. One key tool is futures positioning, like checking betting odds before a big race. Citigroup's latest reports show the S&P 500 leading in bullish sentiment, signaling strong confidence in America's largest companies. We'll break down what bullish futures mean, why the S&P 500 is the crowd favorite, and how this compares to other US and European markets. Our goal: to demystify these trends and help you navigate today's investment landscape. Let's clear up some jargon. Futures are contracts, agreements to buy or sell something at a set price in the future. In the stock market, investors use futures to bet on whether an index like the S&P 500 will rise or fall. A bullish investor believes prices will rise and buys futures, hoping to profit if the index climbs. Adding new long risk means more investors are betting on gains. On the flip side, a bearish investor expects prices to fall and sells futures, aiming to profit if the market drops. When an index is net short, bearish bets outweigh bullish ones. Citigroup's report shows the S&P 500 is mildly bullish. More investors are betting on growth. This isn't just a feeling, it's a measurable trend based on real money. Understanding bullish versus bearish sentiment is key to interpreting market signals. These positions reveal where big money expects the market to go. When optimism dominates, it can fuel further gains. When caution or pessimism prevails, it can trigger declines. Futures positioning is a window into the market's collective expectations. Grasping this helps you understand what's moving stock prices every day. Why is the S&P 500 the market's favorite right now? It's a broad index of America's 500 largest companies. Think Apple, Microsoft, Amazon, spanning every major industry. Bullishness here signals confidence in U.S. corporate strength and economic stability. Citigroup notes investors are actively adding new long positions, fresh money betting on growth. This could be due to strong economic data, favorable interest rates, or impressive corporate earnings. Positive sentiment can create a cycle. Optimism leads to more buying, which pushes prices higher. The S&P 500's reputation as a stable, long-term investment attracts capital in uncertain times. Bullish positioning here reflects a belief in the resilience and leadership of America's biggest companies. Investors are betting these giants can weather challenges and keep growing. That's why the S&P 500 is the focal point for market optimism in early 2026. Now let's look at the Nasdaq. Unlike the S&P 500's bullishness, the Nasdaq's futures positioning is neutral, neither clearly optimistic nor pessimistic. The Nasdaq is tech-heavy, home to high-growth companies that can be more volatile. Investors are split. Some are excited by innovation in AI and biotech, while others worry about interest rates and regulation. High-growth tech firms often rely on borrowing, so higher rates can dampen their outlook. This tug-of-war leads to a wait-and-see approach. Bullish and bearish bets are balanced. The Nasdaq's concentration in tech makes it more sensitive to economic shifts than the diversified S&P 500. The neutral stance suggests investors are pausing to reassess risks and rewards. The initial tech enthusiasm has cooled, replaced by caution. While the S&P 500 offers stability, the Nasdaq's future feels less certain. Investors are watching for clearer signals before making big moves. It's a sign that optimism isn't universal across all sectors. The Russell 2000 is the underdog, with Citigroup reporting a net short. More investors betting these stocks will fall. The Russell 2000 tracks 2,000 smaller U.S. companies, often more vulnerable to economic swings. These small-cap stocks are less diversified and more exposed to domestic risks. Bearish sentiment here signals anxiety about the health of the broader U.S. economy. Concerns include higher interest rates making loans harder to get, and inflation squeezing consumer budgets. Investors are fleeing to the safety of large established companies in the S&P 500. The Russell 2000 struggles highlight a flight to quality in uncertain times. While big companies inspire confidence, small caps face skepticism. The market's mood isn't uniform. Optimism for some, caution for others. The bearish outlook for the Russell 2000 is a reminder of the challenges facing smaller businesses. It's stormy in some corners, even if the sun is shining elsewhere. Bullish sentiment isn't just an American story, it's sweeping across Europe too. Citigroup's analysis shows investors are adding new long positions in major European indexes. The Euro Stoxx 50 and Germany's DAX are seeing strong confidence, much like the S&P 500. These indexes represent Europe's industrial and financial powerhouses. Optimism may be fueled by resilient economic data, easing inflation, or signals of stable interest rates from the European Central Bank. Lower borrowing costs make stocks more attractive, drawing in global investors. The parallel between US and European blue-chip indexes is striking. Big money is betting on the world's largest, most stable companies. This synchronized optimism highlights a global flight to quality. Investors see these giants as best positioned to thrive in today's environment. But Europe's optimism isn't universal. Citigroup notes a mixed outlook for other European markets. Some are lagging behind. Europe is a patchwork of economies, each with unique strengths and challenges. For example, a country reliant on tourism faces different risks than one focused on manufacturing. Investors are bullish on some sectors, cautious on others. This selective approach means capital flows to markets with strong fundamentals. Even in a generally positive trend, there are pockets of uncertainty. The mixed sentiment mirrors the divergence seen in U.S. indexes. Even in bullish times, investors watch for risks, like profit-taking. Profit-taking happens when investors sell after gains, which can trigger a market pullback. Citigroup warns this risk is high for the UK's FTSE 100, where many investors are sitting on big gains. Banking stocks face similar caution, though not as stretched as the FTSE 100. After strong runs, investors may worry the good news is already priced in. This can prompt them to trim positions and lock in profits. Profit-taking risk is a reminder. Markets don't rise forever. Even in optimistic times, vigilance is key. What's the takeaway for everyday investors? Understanding market sentiment helps explain why your portfolio rises or falls. Bullishness in the S&P 500 can reassure those in broad U.S. funds, while caution in the Russell 2000 warns against risky bets. These trends don't dictate what to buy or sell, but they provide context for smarter decisions. Diversification is crucial. Different indexes tell different stories. A balanced portfolio can weather divergent trends. Tracking sentiment is like reading the market's tea leaves. It offers clues about what's next. No one can predict the future, but awareness of these trends makes you a more informed investor. By understanding why the S&P 500 is leading, you gain insight into the ever-shifting world of global finance.